Mark Fawcett, Octavio Ballinas, and
Al
Nicolas
final de esta sesión
Nefouse.
habrá un
At the end
espacio
of the
para
session,
preguntas
there's
de la
going to be a
audiencia, para
Q&A
lo que deberán levantar su mano.
for which you need to
Una
just
persona
raise
de la
your hand.
organización
Somebody
tendrá
from
un
the
micrófono a
organization will have
disposición
a
para las
microphone available
preguntas.
for you.
Les pedimos presentarse brevemente, por
Please
favor,
introduce
antes
yourselves
de hacer su
before
pregunta.
asking your question.
Cerramos las puertas, por favor, a
Let's
la
close
organización.
the doors.
Y partimos entonces
And
con
we'll
el primer
start
panel.
with the first panel, which is generational funds. Ursula, you have the floor. Thank you all. It's an honor to be here with this great panel that I will introduce. This panel will be covering the design and implementation of generational funds in the context in which we are now, in a pension system reform, which is about modifying investment management in Chile. So it's a very current topic. In this case, there will be two speakers who will present in English. So if you need it, please remember that we have simultaneous interpretation. The devices are available outside of the foyer in case you need them. Now I'd like to invite our speakers. We are here with Jaime Casassus. He is Associate Professor of Financial Economics at the Economics Institute at the Pontificia Universidad Católica de Chile. He received a PhD in finance from Carnegie Mellon. He has published in the Journal of Finance, the Review of Financial Studies, and the Journal of Banking and Finance. He's an associate editor of the Journal of Commodity Markets, and he's an alternate member of the Risk Classification or Risk Rating Commission of Chile, and representing the pension funds administrators. It's also a pleasure to introduce Mark Fawcett. He joined Nest as CIO in 2008 to shape Nest's investment strategy, and has been responsible for investment as assets under management have grown from 0 to over 37 billion pound sterling. In 2019, he became CEO of Nest Invest, the FCA authorized investment subsidiary of Nest Corporation, and gradually begins to step down as CIO in 2023. He has also been an investment manager for more than 35 years, holding positions including head of Japanese equities at Gatmore's and CIO at American Express Asset Management International. Fawcett holds a mathematics degree and philosophy degree from Oxford University and an MBA from the London Business School. He has a non-executive role in the Defined Contribution Committee of the Unilever UK Pension Fund. It is also a pleasure to introduce Octavio Ballinas. He has a degree in actuarial science from Universidad Anahuac, more than 20 years experience in the pension systems. Since July 2023, he has been Director of Investments and Treasury at Seguros Azteca and has collaborated with IDB in various consulting and research projects on pension fund investment policies. From 2018 to 2021, he held the position of Finance VP of Consar, highlighting his leadership in the design and transition of the Target Date Funds scheme, modification of the prudential framework for derivatives operations, and changes in the governance of the investment process in structural instruments. In 2022, he joined the Association of Administrators, where he developed the area of actuarial studies. He was also actuarial development manager and internal auditor at Zurich Vida Compañía de Seguros. He structured the self-regulatory process. He completed the evaluation of CFORE at Morningstar to identify opportunity areas of Afores, and he has been a driver of best investment practices and consensus between the authorities and the Afores. I'd like to introduce Nick Nefouse. He is a CFA Managing Director He's the global head of solutions for BlackRock's multi-asset strategies and solutions team and leader of LifePath, BlackRock's global generational funds franchise. The solutions team is responsible for the research, development, and marketing of BlackRock's life cycle and investment strategies. Mr. Nefouse is a member of the Mass Executive Committee and the Executive Committee. Mr. Nefouse has spent his career in a variety of roles related to product innovation and investment strategies in multi-asset. Most recently, he was head of investment strategy for this group, but he oversaw the growth of LifePath franchise, including development of LifePath Paycheck and LifePath ESG, as well as the expansion into new markets in Asia and Latin America. He led product development for the active strategy platform, overseeing the launch and liquid alternatives leading strategy for BlackRock's emerging markets and global equity teams, where he developed a series of dividend-oriented equity investment strategies. He has been with the firm since 2003 at Princeton in New York and London offices, including his years at Merrill Lynch Investment Managers, which merged with BlackRock in 2006. He received his undergraduate degree in economics from Michigan State University. He's a member of the board of directors of the Financial Markets Institute at the Michigan State University Economics Advisory Council. He's a CFA charter holder. He serves as the executive committee of the BlackRock Veterans Network, where he co-founded the Vests for Vets initiative to raise fund and awareness for veterans transitioning to civilian careers. He mentors through the American Corporate Partners and trains youth in New York. So thank you to each one of you. It's a very diverse panel coming from academia and from the private and public context. I believe this conversation is going to be extremely fruitful.
I give the floor now to Jaime Casassus. Jaime, el podio es tuyo.
No sé, yo creo que voy a usar esto. Bueno, muchas gracias por la invitación, gracias a los organizadores.
Thank the organizers.
Lo que me han pedido es que
What I've been asked to is to present, since I'm a professor of financial economics, I will do an academic presentation in the sense of trying to tell you about the fundamentals, or more scientific fundamentals, that support this idea of generational funds, which basically the fraction of risky assets should drop in time. And also, I will try to talk about some other variables that I believe could also impact investors' decisions. Let's start first with some context. Very quickly, things that we know regarding this is going through a second round of constitutional discussion. The idea is to create pension fund investors that will be in charge of managing the pension fund resources. Generational funds that we will cover now will replace the multi-funds. The idea is for each investor or pension investor should keep at least 10 generational funds differentiated by risk level and expected return, in which the mandatory contributions will have to be deposited. Something else that is considered is a gradual change of commissions, and each year 10% of all the non-pensioner contributors will be part of a tendering process, so that they may shift from one investor to another. And in case this project or this bill is approved, generation funds would start operating 3 years after the law is enacted or published. What are these general funds, or target date funds, or life cycle funds? And they are basically these funds in which assets are chosen, the risky part or the mix changes according to the retirement horizon. Those who have a longer horizon will invest more on riskier assets compared to those who are closer to the retirement age. It is important to mention that these funds have this dynamic strategy, and they intend to reduce fixed income. The dynamic is known as glide path, and that glide path is both in terms of the time series. As people age, the fund changes dynamically in its structure, but it's also seen across the board when you look at people from different ages with different retirement horizons, what the makeup is in time. For example, 10 generational funds that could be perfectly the ones that could be offered is basically with different retirement horizons. It could be for those who are already pensioned, and every 5 years we could progress from 2025 until 2026. 65, thinking of the people who are about to retire in the next 5 years until those who are just joining the labor market that will be retiring in 40 more years. That is the idea now. And these funds in general are funds made up of funds. They invest on mutual funds and they rebalance the investment as time goes by. Here, I hope Nicholas agrees with this. This is just one example of BlackRock LifePath index funds, which basically we can see that they are mainly according to how many years until retirement, younger people who have still 45 years ahead of them, and these are the ones that are about to retire. And what is the fraction between equity funds, including real estate investment trusts, or there are alternative ones there, as well as the fixed income funds that goes from 99 to reach 40%. We can check here what Vanguard presents for its this is the glide path for its generation funds or target date funds. There's a significant difference, close to 90% both in international and US stocks. Also in terms of fixed income is nominal bonds or international bonds, and some at the end that are also short-term instruments that are inflation index. This is a younger person, this is the age, and this could be these are all the funds. One would have to check every 5 years how the funds are structured, but the fund, it's fixed. Time runs and it changes and it scans the entire glide path or the investment strategy. Let's see now what should be the objective of these target date funds, which is basically improving future pensions. We would love to maximize the amount that we are going to have when retiring, but of course, since we are investing on risky assets, we could say maybe we could maximize then the expected amount when retiring. That somehow recognizes there where we're taking risk when investing, and basically there needs to be a combination. On the one hand, we want to maximize the expected amount, but somehow we need to recognize that there are risks involved, and a reasonable objective would be an increasing variance in the risk. All these variables that we're discussing in the long term, and that's the issue, of course. Maybe it's not. Maybe it's not that complex to measure the long-term return, which is the variable that we should be looking at, but it is quite complex to measure long-term risks. It is always a challenge, not only for us academics, but also for practitioners. The investment decision is something that needs to change in time, so the model needs to be dynamic. Although sometimes the base model in portfolio choice from Merton 1969, which is not necessarily optimal to rebalance. The idea here, in terms of risky assets, this is something constant in time, and it is, no matter how dynamic the model is for the specific horizon, it is exactly the same as the mean variance analysis for a static model of any period, and it breaks it down. But I've separated this Merton model, because we're going to discuss these two terms, into market characteristics, which is basically a compensation because of profitability based on a certain risk, which is a variance. This is typical of the market, and also it relies on the individual's characteristics, his or her wealth, and also risk aversion of the individual. And since we're going to be maximizing something in the long term, there are people who will be more risk tolerant and others that will be less risk tolerant. Basically, these target date funds propose that the fraction on the risky asset depends on the investment horizon. So let's see now some evidence. And I really like this invitation to be here, because it forced me to go over several recent papers. Portfolio choice has been a very strong topic in financial literature. However, with the popularity of these target date funds, much of that literature has created new literature with a portfolio approach, but by applying these TDFs. So every time there's something in blue, these are some of the papers, and if you download the paper, you'll find the link, so you can actually have access to the documents. Let's see what's happened in the US. There's lots of recent literature and evidence of how the performance of these TDFs has been. First thing is that in the last few decades there's been a transition of defined benefits plans to defined contribution plans. And in 2006 there was a significant reform, because there was the Pension Protection Act, which means that these TDFs to be alternative by default, defined by employers. The US, the employer system plays a significant role, specifically in 401k funds, in which the employer contributes to the fund and offers certain choices, long-term investment choices to the employee. And there are some matching funds mechanisms that can operate as well. And also, lately, there are individual retirement accounts, in which the work it's kind of similar to the system that we have here in Chile. They've gone to these DC plans, defined contribution, and they are based on the popularity of these TDFs. They're simple, because give me your money, I'm in charge of this, you don't need to decide where to invest, and on top of that I will rebalance as you age, basically, because I'm going to be taking risk and making the investments according to that. There's a recent paper by Mitchell and Utkus in 2022, where they say that this change has been extremely beneficial for pensions. TDFs in the US allowed for people in their own decisions when joining this, instead of having to invest. Many of them were investing on the stock of their own companies. The target date funds allow them to allowed for the fund administrators to start investing a larger portion on riskier assets with the compensation according to that, and that has improved the risk-return ratio in those investments. I will show very quickly some empirical data from this paper by Chauvin and Walton of 2021, where they basically analyze 612 target date funds. They are organized or broken down by time horizon, and they also have these balanced funds that they're quite similar to our 5 multi-funds here in Chile in terms of their makeup. The one in the middle has possibly 60 to 40. 60 equity is the largest as well, so it is equivalent to our C fund here in Chile. This is a comparison in terms of operational expenses and what kinds of risks are being taken. I will focus more on generational funds. First, this is what I said before. This is the exponential growth that has happened. This is the size of these TDFs, and currently figures change, but here in 2019 it says that 1.4 trillion that are mentioned here of dollars invested. Currently, there's several documents reporting that the invested amount by 2023 is above 3 trillion, and that shows the impact on the workers' decisions, employees' decisions. This is broken down by types of funds, and not much to say really, except for the fact that the largest funds are those of those who are about to retire, possibly those who are already 55 or 60 years of age. Between 2025 and 2030 are the biggest funds, and of course they are valued at market price, so they are showing market variations, but the growth also happens because there are people joining the system.
So if you see the balance funds, and this is also, I mean, if you see the contributions made to the funds over time, and you see that the contributions go down, it's basically because contributions have moved to these new products that are not really new anymore. In the United States, they've been there for many years now, as we can see from the previous slide. So the only thing that I'm saying with this slide is that, in general, particularly people who are joining now the system, I mean, they join, but the amounts are small. One thing is the number of people, and the other thing is the size. So basically, they adapt this new system of the target date fund. Now, these are the target dates funds that I'm showing. These are generational funds that are arranged based on operating costs. So this could be a good proxy for commissions, for instance. Now, this is sort of like a bimodal distribution, so we have quite a significant group, the largest actually, with very few operating costs, and here we see, I mean, it's 0.2, it's 2 base points a year. So these are basically, this is basic investment. So what these funds do is that they have low operating costs, and they even invest, I mean, companies offering these funds normally have mutual funds also. So they offer a target date fund for a given year, and then I invest in the mutual funds of the same family. It's sort of like a combination of variable and fixed income. And there are other funds with higher operating costs. I mean, even 70 and 80 points. And they tell you that they have active investments and that they are making decisions all the time, so that they add value to the process. And those things sometimes work, but not all the time. So the most scientific analysis about this paper is that they say that each of these 612 generational funds are broken down in 13 factors. They consider 13 risk factors, but instead of considering factors that cannot be interpreted, they consider mutual funds with operating costs and mutual funds with variable income. Then they have fixed income, and then they have mutual funds with alternative systems. So they say, okay, based on the return, there are certain restrictions in terms of the parameters, the weighting is different, so they try to replicate calculate, using these 13 funds, what is more similar to a generational fund, which is the one that they started analyzing. So they do this for each single fund, and as you can see, this is very typical of financial analysis. The alpha, it's very important because the alpha measures the yield difference a month between the fund and the benchmark that they built based on the 13 funds of different nature. So first, the generational funds do what they offer to do. I mean, when you see, well, here I have the retirement. I mean, young people is to the right. So people are investing more in equity and not so much in bonds. So this is the green boxes. So here we have the intervals of confidence. So what you say is that what they offer is what they are doing. So just by looking at this analysis, the regression analysis. So if you focus on operating costs, we can see the alpha. A positive alpha means that the funds are doing better than the benchmark. If a negative alpha, it means that they're doing worse. So in general, what happens is that to the left, we see the TDF, and to the right, we see the balance funds. Now, in both cases, the same happens. And I see this as an evidence that active investment doesn't add value all the time, because what's actually happened is that in general the funds with low operating funds, either TDFs or balance funds, they have an alpha close to zero. So basically what they are doing is they are just transferring based on the commission that you pay, and they buy funds and they just rebalance according to maturity. But in the case of those with higher operating costs, because they have active investment, normally they have a negative alpha. Now this is an evidence in favor of basic investment. Now there are some other results that I also reviewed. Some are recent, some not so much. Some say, for instance, in the case of Elton, they say that TDFs they're not very standard in terms of the decisions they make. It's not just actions and bonds, but in general, they take certain risks in terms of market timing or an investment that it's a little bit more active. In general, they don't add any value to the fund. Now, there are some other results that say that the good thing about these funds is that the employee doesn't need to be analyzing what happens with their fund. But at the same time, that means that the administration funds take advantage of that, and they punish younger people because they give less yield to younger people because they don't really focus on what's happening with the behavior of their funds. Another important result is that there is high heterogeneity in the funds, so they invest in alternative funds, in commodities, and that's part of the risky part, but it allows diversification also. And in the face of the same investment horizon, you may say that, okay, maybe these funds are trying to offer riskier funds to people who like risk, so they try to make a match with the profile of the person. But according to Bartusi and Reuter, in this article from 2019, they say that they assume higher risks in order to increase. They take more risks to increase their fraction in the market and to get a higher equity share. Now, this is something we like very much about this last paper, which is to show that flows affect prices. I mean, this is always quite an interesting discussion in economy and finance, and this paper by Parker, which was published last year, say that this is not just related to TDFs, but also it applies to balance funds. If you have a given strategy, if you do well when it comes to variable income, you just go and sell your position to maintain the fraction that you were offering. So there is a natural rebalancing, and that rebalancing is a strategy that it's opposed. I mean, you sell when you're doing well, or you buy when you're not doing so well. You have to maintain the same portion that you're offering. So this rebalancing now, based on the importance of TDFs, have a positive effect because they stabilize mutual funds where they are investing. So they compare mutual funds where they invest the TDFs in comparison to the mutual funds where they don't invest, that only reduce volatility of the funds where others invest. Okay, I'm just going to close with a question. Does it make sense, the proposed glide path? And I would like to focus on two things here. We could say that these are the arguments that contribute to the hypothesis that the TDFs reduce the fraction. One is the predictability. I mean, we have market characteristics and the characteristics of people. In the case of the market, we have predictability or customized reversion of the share returns. In the long term, because there is predictability in the returns, in the long term, the risk-return ratio improves when it comes to the longer term. And in case of individual characteristics, of course, the argument in favor is human capital. When you are young, you have a lot of human capital, and that human capital, if behaves as a bond, then it means that you want to invest a high portion in shares, and as time goes by, your human capital goes down, and of course that reduces the portion you have on shares, on stock. There are some other arguments, such as risk aversion, that comes with the age. That's debatable, of course. And another argument is the low financial literacy. Now, predictability in the returns. This is the typical graph. Whenever you see long-term returns, and the deviation, the standard deviation, the risk goes down. And this is an argument in favor of that. Now, this is evidence that there is predictability, that there is custom profile. And if you have a longer term of investment, there are certain market conditions which are better when it comes to a risky asset, and you should invest more on that. I'm going to skip this slide, but it's just, again, evidence in favor of predictability. Now, in terms of duration, young people should invest more in the longer term. So, and this is debatable, of course, but if the duration of the shares is higher than the fixed income, maybe that's also an argument in favor of investing, if you're young, on a longer term and in variable income as well. Now, we know a little bit about the duration of stock. About the future of the indexes, we can know a little bit more about the expected dividends, and we may get a kind of duration, but it's not an exposure related to the interest rates. Anyway, so this is human capital. If this is the human capital, most of your wealth is your work, it is you, and your financial wealth is so minimum that you want to invest almost everything on stock. And of course, this changes over time. Now, what happens? Sometimes the correlation between your work income and the market may be positive. Now, in aggregated terms, of course, because that's very much related to economy. But individually speaking, that's not so obvious. Now, what it is obvious, though, is that, and there are some papers that argue that if you have higher levels of education, and because of the type of work you have, your employment has a positive correlation with the market, which would tend to say that this is not so true, that your human capital is not an asset, but it's actually more similar to a stock. There is a paper that deals with this even longer, and they say that even though correlations are small, there is co-integration between these two variables, between your income and returns. Now, if that's the case, in the long term, the co-integration would make sure that these variables work together, are aligned, and that can also translate into a long-term correlation. Now, this paper of Benzoni and others says that the human capital even if you're getting started, it's sort of like an exposure, a leverage exposure to stock. I mean, this is positive, you have a lot of risk, and then you're negative when it comes to bonds. So it's not just similar to stock, but it has a leverage position. Now, of course, the result they claim to have is that people initially don't need to focus on stock because they are assuming risk with their human capital, so they can actually increase. I mean, the situation would be reversed to that of the TDF. The only thing that I want to say is that we need to be very careful when it comes to this. Now, there are some other characteristics, and I'm really going to close with this, but there are some other characteristics that affect the investment decisions. One is the life expectancy, which is also related to time. I mean, how long I'm expected to live. So women live more than men in general. People with higher income live more than more vulnerable people, and that in Santiago people live longer than people from other regions of the country. So this could also be, we could use the same variable with the flexibility that if I should be retired in 10 years, given my characteristics, maybe I could play with that period. So I think that some TDF do that. Another thing that is very important to me is the heterogeneity in the preferences of people. People are different in terms of the risk aversion. I may want to maximize something in the long term, but that risk may be annoying to me, and some other people may not feel annoyed by that. So I think that this is something that we should consider, which is what multi-funds do now. Multi-funds focus on the risk profile, or they could be mapped according to the risk aversion of employees. The risk of income, the type of work you have, properties, and whether you have any debts, any mortgage. For instance, I'm leveraged to buy a house. That's also part of my wealth, but with a high level of risk. So I would have to see what are the correlations between the real estate risk and the market risk, which most likely are positive. Actually, there is a recent paper that measures the cause and effect, and they think that investing 10% in a house, it means to reduce by 6 your fraction of stock. Of course, that has an impact. Oh, it depends on the family, of course. If there's just one income in that family or two income, that all, of course, it's going to have an impact on the decisions. There's some tax issues, of course, but there's a recent paper that uses machine learning to quantify how much is the well-being loss if we consider all of these characteristics in comparison, I mean, in terms of following the strategies of a TDF. And they determine that in terms of equivalent consumption, they lose between 2 or 3% of the consumption of each period. I mean, it's quite a significant loss in comparison to following an optimum selection. I mean, this is actually a very complicated paper, so this is why they say that they can solve all of this using machine learning, but they quantifying all that. Now, in order to close, to me, what makes sense is that investment in risky assets to go down over time. Actually, multi-funds have certain rules about that. I only have 4 or 5 years in fund A, and then I have to move and change to a different fund. Now, the rule of a TDF, it's just going to be good if we have a simple model. If you add other things, of course, the situation is going to be different. Predictability, for instance, suggests that we should have something related to market timing so that the administrator or investors can do that within the type of assets. The investment decisions are complicated and should at least consider the individual preferences, such as risk aversion. And there's some other things that I don't really have the time to discuss. But I think the transition is important. We know in Chile about the effect of changing funds and the effect it has on the exchange rate, interest rates, for instance. So we need to be careful with these transitions so that they are gradual, so as to avoid affecting the equity market. And there's always an outstanding task in terms of how to measure the performance of these funds in the long term. And what fund, of course, the TDFs or the balanced funds. I mean, we need to know how to measure risks and the yield. So, thank you.
Good morning, ladies and gentlemen. I apologize. Despite my wife being half Mexican, my Spanish is really bad, so I will do this in English. I'm Chief Executive of Nest Invest, the investment subsidiary of Nest Corporation, which is the largest defined contribution scheme by membership in the UK. It has 13 million members, and as you can see, we're actually over $50 billion of assets now. We are used by 1 million employers across the UK, ranging from the largest, McDonald's, for people in the burger joints, have a Nest pension, right through to people who have a nanny to look after their children and may enroll them in a pension fund. So we've been automatically enrolling people into pensions since 2012. And Nest has about 1/3 of the UK workforce as its members. So that's an introduction to Nest. The differentiating characteristic of our membership is they tend to be lower paid. So the average salary in the UK is about £30,000, and the average salary of our membership is £20,000. And we have a lot of minimum wage workers. So that is really important when we're thinking. Jaime was talking about risk capacity or risk tolerance. It's really important to think about the demographics, the characteristics of a membership when you're designing the risk profile. And I'll talk a little bit about that in a moment. First thing is we needed some clear investment goals, and the primary one is about delivering good risk-adjusted returns, and I'll talk about how we did that. But also, we're part of a big pension system in the UK and increasingly globally. So trying to invest in functioning markets and improve the functioning of markets. Ultimately, we're trying to improve the retirement of our members. And thinking about how they take their retirement income is also critical to the design of the glide path that Jaime was talking about. And finally, so in the UK, people can stop saving or they can switch to another provider. So building trust is also really important. We've had a global financial crisis. UK financial institutions and banks did not shine in the financial crisis. People distrust finance, they distrust pensions, and therefore building the trust at Nest was really important to us. And therefore we manage the reputational risks as well. We maybe get into that in the Q&A. So, I know in Chile you have these 5 fund choices that people can make, and there are different risk grades. We wanted most, if not all, our members in the default fund, which is a series of 50 target date funds, one for every year retirement from someone who's 22 right through to retirement age, which is 66. And we manage those target date funds very carefully, and we don't ask people to make investment decisions. So Jaime was talking about people's risk tolerances, and you know, they may have a pension, a mortgage, and they may have savings. Most people don't understand their risk capacity. So we try and manage that for them. People aren't interested in pensions generally. They don't know about investment. Why should we blame them for that? They have jobs to do. So let's design. Our goal was to design a system that required the member to do nothing but put their contributions in. One of the things about the risk-adjusted returns was we wanted a diversified approach. And I'll talk about the diversification and how we achieve that in a moment. So why target date funds? Well, in the UK, what used to happen was you had one big fund for all members, and then as people approached retirement, they were switched individually into different, into lower risk assets, into fixed income assets. For 13 million members, administering 13 million different accounts is just asking for mistakes to be made. And the cost of unwinding, of correcting those mistakes is really high. So by dividing our members into different target date funds, different cohorts, that means administratively it's a lot easier from an operational perspective. But then we can manage the risk for different cohorts. So our younger members, for example, have a lot more in illiquid assets than our older members because they can invest for a longer period. So all the things that Jaime was talking about. Where we would differ is how much risk you give people at different times. Probably can't go into all the details because I know time is tight, but we can discuss it maybe in the Q&A. How can you invest in illiquid assets when people are making contributions all the time or are approaching retirement and need to have more liquidity? Well, we created an internal market. So older members are selling their private equity and their infrastructure to the younger members. The 60-year-old sells to the 25-year-old. So we don't have to impact the market. We don't have to sell our illiquid assets into the market. We just transfer them between members. And this is our glide path. So we have 4 phases, starting with the foundation phase. This is for our very youngest members. They have no money. They have like, £100, £200. It actually doesn't matter how much risk you take for them because they've got such small amounts of money, but we want them to build up confidence. Most people have never invested when they're 22 years old. They don't want to have a lot of volatility in the market, so we try and manage the volatility. Not so much equity risk, more illiquid assets, which are less volatile. Then we go into what we call our growth phase, which is for the vast majority of members, most of the time they're investing. We take a lot more risk. We're targeting inflation plus 3% returns or more, and we have a lot more equities, a lot more private equity, a lot more high-yield bonds, the sort of things that really can generate growth. And then as people approach retirement, we start reducing that equity risk, as Jaime was talking about. But the key thing is we carry on investing through retirement. So our post-retirement phase, we still have equities, we can have illiquid assets, we can have high-yielding bonds. It's not just all in low-yielding government bonds. Now, back in 2015, the Chancellor of Exchequer, our finance minister, decided the way you could take your pension was going to change. People used to have to buy an annuity, which was, required a different investment strategy to the new way, which is you can take all your money out whenever you want, as long as you're over 55. So for us, that meant we didn't have to try and manage the risk to annuity prices. We could invest through retirement. We had to change our glide path as a result. We had to change the asset allocation for people in their 50s and 60s. It's much easier to do that when regulations change in the target date structure, where you're splitting people out by age, than if you've got all the money in one big fund and you have to change by individual account. So, just a bit more detail on those different phases, and I won't go into that now. We'll share the slides. I want to just talk about how this operates in practice. So we have 3 members here. The lady here is in the 2060 fund. She's only just started saving. The gentleman in the middle is in the growth phase. He's making his money work as hard as possible. And the gentleman on the right, lots of grey hair like me, is basically approaching his retirement. So he is taking his money out now, or he might take it out in little bits as we invest it for him. So we invest in a whole range of different asset classes: property, credit, private credit, infrastructure, EM debt, EM equities, global equities. We're geographically very diversified. The UK government doesn't specify how much money we should have in the UK, so our global equities are completely global. We have a lot of NVIDIA and Apple and all those sort of things, and that's been great. We do currency hedge some of it, but the key thing here is we're not tied to one provider. So we negotiate deals with fund managers. Properties managed by a company called Legal & General in the UK. Private credit, we use 3 different managers in the US and in Europe. Infrastructure equity, including renewables, is 3 different managers. So one, we get very good prices because we've got so much money coming in. And secondly, that alpha, where we are seeking alpha, we can go to the best managers in that particular asset class. Sorry, BlackRock are very good, but they're not the best manager in all those asset classes. So being tied to a single manager, such as a Vanguard target date fund, really restricts how you can access the markets in an optimal way. And you can see the diversification here across a different range of asset classes. A lot of equity, but not 100% equity, not 75% equity. The private equity portfolio is building up now, but we have real assets, we have investment grade bonds, we have high yield bonds, we have commodities. And we'll vary the asset allocation both by age and also by market conditions and opportunity. We've evolved as we've got bigger. I can talk a little bit about that later if there's questions. So I just wanted to reflect on this internal market. So I read a paper about the Chilean scheme where I think the highest ratio of private market assets was about 12–13% in the riskiest fund. So we've got a 20% target at the moment. We're just shy of 20% in private markets. We're going up to 30% across the scheme. So as I mentioned, the 2026 fund, for example, it is reducing its private market asset exposure because these people are coming up to retirement and may want to take all their money out. The person in the 2065 fund wants as many illiquid assets as we can give them. They tend to be lower volatility, they don't price as often, but more importantly, they've got a very long investment horizon. So we transfer, we determine fair price, and we transfer the assets at that fair price from 2026 to 2065 fund. No frictional costs, we don't have to go into the market, we can reduce costs, and as a result, our transaction costs in the whole scheme are exceedingly low. And then just finally, it's really important to have choice, but as I said at the start, we want people to be invested in the default fund because they get access to all the benefits that I've talked about. The illiquidity, the diversified portfolio, the low costs. But some people just don't want to invest like that. They want to invest in something maybe relating to their beliefs, like the Sharia fund. Maybe they want to invest in, take more risk. Maybe they want to take less risk. But we have deliberately designed our fund choices to be complementary to the default fund, the target date funds, and at the same time, relatively unattractive. So we know most of our members don't like risk, so we call the higher risk fund higher risk. If you really want higher growth, if you go into the higher risk fund, you are likely to get it, but you're not going to get the illiquidity and all the other benefits. More importantly, the lower risk fund, which we thought might be attractive to low paid people who've never invested before, we deliberately called it lower growth, not lower risk, to make it less attractive so that people end up in the default fund, which is where we think it's best for them to invest. So it's good to give people choice. It's good to discourage them making too much choice because we know people make mistakes. Markets fall, they take risk off. Markets go up, they put risk back on. So actually having a choice framework that plays against their behavioral biases rather than with their behavioral biases is really helpful. So on that note, I will finish and very happy to take questions in the panel session.
Thank you so much for your amazing presentation, Mark. I invite now Octavio to the podium. Please, Octavio.
Bueno, muchas gracias.
Okay, so in order to continue with this panel discussion, I think that there's quite a difference in terms of the experience, for instance, in comparison to what we just heard from Nest. Nest was the result as a vehicle, as a target date fund. So what we had to do in Mexico was that we were in a vehicle on the run, and we had to change vehicles because of certain circumstances that I'm going to describe. But of course that shows you a challenge, a different kind of challenge. So how can you make an organized transition on a pension system that had been working for 20 years using different models, such as the multi-fund system, for instance? So what triggered the change? It's just the model and its interpretation. I think that all the individual systems here in Latin America see the same. There is few understanding on the long-term investment. We have to remember that when we talk about long-term investment, the first thing that we are assuming is volatility. Now, in order to get an expected yield in the long term, in consistency with pensions, we need to assume volatility. And since these are mandatory funds, then they are a risk for holders. Now, in the case of Mexico, every time the interest rates go up, there are quite a reduction in the market. We question the value and the management of the pension funds. And of course, again, we want to go back to the defined benefit system where you don't have any volatility because the benefit is already defined. But we need to consider that this is one of the key parts of changing models, which is to put the investment decisions where they should be, which is according to the long-term rate. Now, what about the risk for a contribution payer that it's under an individual system? You know, the tolerance and the difficulty to mitigate risk. You know, when we deal with investment management, if it's that we are all very good to measure the second moment of the expected returns, which is the standard deviation, right? I mean, risk is it's something that we understand how to measure it, but we're not very good at measuring the expected return. So if the markets go down or up, so we need to focus our management or the management of the resources, not just in the terms of the market time, you know, how much I can add in terms of value in a 45-year period. I mean, I cannot really add too much to a pension fund. Actually, the long-term yield it's given by the asset allocation that I'm going to choose. Now, what's the risk? The pension risk. I mean, the risk for resources at the time of retirement are not enough. Or that's the risk people are subject if they are part of the individual system. Now, we also need to consider the information that is communicated to our clients or to the audience in general. If we talk about long-term returns and if we assess everything in the short term according to inadequate variables, we are actually focusing the discussion around variables that actually don't quantify the risks of people or that people have to face. This is a very simple balance, maybe. So we have, on the side of the asset, we have the resources. I mean, here we simplify this in rates based on and the capital is the same, but rates are affected to depreciation, and when the rates go down, then you have an excess gain. Now, the issue that we never focus on is on the passive side. You know, what happens to what I'm going to buy when the rates change? For instance, annuity income are set at a price according to the actual rate in the long term. In Mexico, we know that as uni bonds. In the United States, and they have bonds indexed to inflation. So that's what determines the cost of an annuity income. So at the time of retirement, a pension fund administrator needs to focus on the price they need to use to invest the savings of that employee to pay a pension for 25 years, for instance. That's the main issue. So if the rates go up, the pension cost goes down because it's the present value of those bonds. So what we see to the side of the asset is a tragedy. So I have depreciation, but on the side of the liability, the pension cost goes down. So in the worst case scenario, I mean, in many cases, the cost of pensions could go down far more than what the value of the market is losing. So that's the thought in terms of why it's worth to assuming volatility in terms of pension funds in order to optimize the return rate. Contrary, when the rates go down, on the asset side, you can see that you're gaining a lot, that you're getting very good yield, but the cost of what I'm going to be buying is going to increase. So then the ratio is that if the yield that I'm getting is going to be enough to compensate, to offset the increased cost for my pension. And that's the focus on the long-term strategy. Similarly, we can see in blue is the action or the share price of a CF40. I think that in Chile the situation is similar, and also the cost of an annuity. So we can see the CF40 price goes down, but the cost of an annuity also goes down. So all of these headlines that we see and that make us concerned about depreciation or loss in prices, that we are assuming too much volatility, it's nothing really, because in the long term nothing happens. It's just an assessment, or you can actually maintain the level of the replacement rate. Now, what's important for employees or for the contribution payments is the long-term yield based on the price of the share, or CF40 in our case. So we need to focus on the strategy in the long term. The CF40, as we call it in Mexico, or the pension funds administrator, they need to understand what's the risk of the holders. So this implies that they reduce volatility to the short-term portfolio to look better in the picture and to avoid jeopardizing the reputation risk that affects the short-term, because they are assuming the volatility of the portfolios. Now, according to Professor Merton, the yield based on the pension units, which is how many annuities or how many units of annuities I can buy at the time of my retirement, because that's what's going to be paying for my pension. Now we need to show a comparison, because the purpose of the savings is to fund the pension, and I'm not very sure that in our systems people actually understand that they are saving for a pension, not just to get the money at once. And that changes the way in which the resources are invested. You award the long-term strategies because you don't create any distortion deriving from volatility events. I mean, if an administrator can be foreign to the volatility, they are going to maintain the long-term strategy in order to optimize the strategy, and they write off certain short-term strategies. They punish the short-term strategies. Before the default in Mexico, there was someone very famous because they would invest everything at 28 days or 90 days, 62 days, or a year at the most. And then when we experienced situations such as that from 2018 or 2016, it looked fantastic, you know. Everyone wanted to do that because they had a great yield. But then if we analyze that in a 10-year period, the impact on the value of the savings of those employees is amazing. So again, we go back to this idea about the short-term measurements. And of course, we need to have very stable and consistent rankings. I mean, we cannot say that in 1 month A is good and 3 months after we say, no, you know, fund B is the best. So that creates a lot of changes between the contribution payers, because they need to have the opportunity to select their service provider with clarity, but they need to have information to avoid any errors. So what are the deficiencies that we see in terms of the investment management? So SAR had 5 funds. We call it basic CF40, and the definition of the ages of the employees of CF40 of these funds didn't focus on the demographics. they just did it like this, random, to divide the funds. And the resources of the individual accounts were transferred from CF40 whenever the employee would change that, and that created deficiency leading to risk. So if every year people of certain age need to change funds, that creates some friction, because if today you are investing 15% in variable income and then you had a significant loss in the previous month, and then you're going to move to a fund where you're only going to be able to invest 10%, that's something that you can never recover from, just because of the models the fund have. So it's not the best model to develop a long-term strategy. And we need to think about this. When you measure the profitability or the yield of the multi-funds, you need to see who actually receives the yield. If we say that basic C44, for instance, increased by 10% over the last years, none of the employees receive that benefit, because none of them maintain in the same fund for the entire period. So the management of the fund may have had that yield, but none of the employees receive that. So it's not a good way to have a long-term strategy. Now you're talking about the illiquid assets part. That's not a good mechanism either to manage illiquid assets or alternative assets. Because if I'm in the most aggressive fund and I have a 20% exposure in alternative assets, and just because my age changed, I have to reduce my exposure to 10%. I mean, you have to remember that alternative funds have a J-curve, so employees fund the entire investment project with zero return, but they assume the loss of the J-curve, and when they are going to start recovering the investment, you change them. They are moved to a different fund, so they're going to reduce their yield. So it's not a very good model also to manage alternative investments. And you need a complex system for the work of employees every year, because every year they had to work or made an effort to change funds. They need to get organized and see how things were going. I mean, it wasn't very simple. Now, this graph shows what was happening. So we started using just one fund, and then in the year 2004, we changed to a two-fund system. The purple line was the fund of the employees closest to get to retire, and the blue one included all the other employees. So we moved from a one-fund system to a two-fund system. Now, in the year 2008, we started working with 5 funds. Now, the red line disappeared, which is the basic CF40 fund. And that started showing the problems of the model. It was the fund of the youngest employees. So at some point, that fund was too small to manage, and it became smaller every time because it started sending resources to other funds. And new people to the employment market didn't offset that, so it became closer every time, until we made a decision to work only with 4 funds. But then there was just one fund that managed people of age between 18 and I think it was 27 years old. So there is no relation between the investment behavior of someone who's 18 or 27 years old. So, and that's how the funds worked until 2019. Now, what's the forecast of assets that we had at the time? The funds would focus on the CF40 Básica 2, and we would end up managing a very big portfolio of money in just one fund, because of the inertia of resources and demographics. So we would go back to the one fund, to a one-fund model at the end. I wanted to show this, the change of the risk profile, which is based on age. It's like that. It shows us in the graph, like moving in a stair. It's an abrupt change from one moment to the next. Now, what are the advantages of the TDFs? One, which is the most important characteristic, is the investment trajectory, which is, the glide path, as known in English. So that's the most important characteristics of the TDFs, because establish the risk exposure during the life of the fund. And I'm going to make a comment about the design of this policy. So if everything is focused on the glide path, and the glide path is where the administrator actually reflects the long-term strategy, it's quite important to actually deliver on that. In the US, we have all the funds that we are going to be hearing from, but I mean, all the funds are listed. Are listed. I mean, they have an investment prospect, and they need to comply with that. If they don't, the consequences are quite serious. So, where they are listing a glide path, they deliver on that. It's like a contract. So, for instance, in Mexico, we already had the experience of the CIAFORES said, yes, I have my benchmark, I manage that, but then when we ran the analysis, the tracking errors were close to 25 or 30% a year. So the benchmark was just a story. I mean, in reality, they did whatever they like.
So one of the very important aspects is, how can I make sure that the fund manager will comply with that glide path that he himself designed? Because it is important who designs it in order to have a differentiated offering to different risk profiles in the industry. International experience of portfolios initially invested between 80 to 90 in variable income, also 40 to 50% at the landing point. And I'm going to discuss that. One of the biggest problems with the Mexican system since it was created was low exposure to variable income. First, because of the design of the investment regime. Mexico at the time was coming out of the 95 crisis that was mentioned a while ago. We wanted to be very conservative in designing these funds. The last thing we wanted was to have another event that would destroy a system that was just starting. And it was justified, but it stayed the same. And I believe it became an idiosyncrasy among the pension fund managers that do not want to invest on variable income, let alone on local market variable income. Then there are many, maybe I can share a few opinions, I guess. But the fact is that they don't do it. Just don't do it. The glide path needs to consider the characteristics of the affiliate and the investment characteristics. That's something that I mentioned. It should establish the date and the cohorts. What I said before, we should have options diversity in the market. Clearly, when we look at the target defaults, we see this is a model in which we can offer different strategies. At first, we envisaged the possibility that the regulator would issue a single glide path that everyone had to follow. That is a good way of freeing up those pension fund managers, freeing them from designing strategies and for the regulator to take on all the risk. Each one must develop their investment strategy, but they need to comply with certain parameters in that investment regime. But they are the ones that are charging for designing the strategy, after all. I will skip part of this, but I will focus on the meat of this. It puts the discussion where the employer needs to improve the replacement rate, to eliminate the operating risk of that transfer every year, the liquidity risk to markets, that the worker could recover from, that they're reducing their risk as if they are actually sliding down a gliding surface, and it allows to increase the risk context. That was a very important premise, and now that I checked what Consart publishes, I think it has not been met, and we are going to see it soon. Where is this replacement rate improvement coming from? Larger exposure to assets in an initial stage and divestiture, which is softer at the end of the date. Basically, this is where the development of the replacement rate will be coming from. More exposure to risk and a softer diversification. I will skip many of these slides. I will just focus on the final comparison. In terms of the multi-fund or CFOs families, we had broad age ranges. It did not focus on the replacement rate. There were significant investment strategy changes. Worker did not receive the benefits of alternative assets. The worker changed CFO, and there was on the other side, we have strategies focused on generation, maximizing expected pension, smoothing out a transition regarding investment strategy, and a clear reference needs to be overcome, which is according to the replacement rate. This is what we did. I'm going to make this presentation available for you to read it. Basically, what we do in terms of risk, it is a risk if we consider the traditional risk of portfolio management. In the x-axis you have risk, and the y-axis you have performance. Risk is the worst scenario, and in the y you have the median of the pension. There are different runs. You start with current in red with 45% of variable income. We increase that limit with combinations with the premise of I cannot increase the first percentile because it's the worst result. If I do not increase that and we increase the median of the pension, I can increase the risk. And this is how the investment risk was designed, on which pension fund managers need to design their glide path. We got to 60% of variable income, and we landed on a 15%. Based on that, we drew the rest of the investment limits. We have an aggregate profile of the total risk assets that the investment risk could consider. Let me focus on the outcomes of all this. CFOs are mainly, after 4 years of implementing them, just a few thoughts. CFOs are mainly being fixed income funds. The variable income of the most aggressive fund, for example, has not grown since February 2024. They remain at 20% almost. But the biggest symptom is that before the change to the TDFs, they had the same exposure, 24% to variable income in February 24. That is 24%. There's a lower consumption of those limits because the limits were increased in order to design this vehicle. The aggregate limit went from 35% of variable income to 49%. So it's quite symptomatic that the Mexican pension administrator doesn't like variable income, at least the local one. Exposure takes place through derivatives, which is the conditional VaR differential. When there is increased exposure to variable income, this measure grows. So positions that they are taking in terms of variable income, they are doing it through forwards and futures, indexed instruments. It's not bad, but it's symptomatic of the fact that they're not doing it in the local market because there are no forwards or futures in our local market. Where I do see an important increase is the average horizon. So duration have grown. At least pension fund administrators have forgotten about the short-term volatility, and they have increased the duration of those portfolios. And at the end of the day, that will have a positive impact on the expected returns on pensions. I will dwell on this a bit. A fundamental part of the design was the tracking error. I said at the beginning of this presentation, how are we going to make them comply with the glide path? We introduce a tracking error regulatory measure, volatility of yields of a glide path limited to 5% on an annual basis. That's gone to half of it. It started the glide path design had to be a long-term design, so in order to avoid having the same glide path, which was exactly a portfolio they had now, we had a broad tracking error. That's why it started at 5%. It's been reduced to half, to 2.5%, what doesn't have an explanation is why funds of those who are furthest from retirement, the 1994 generation, have a tracking error of almost twice as much compared to the funds of those who are closer to retirement. This makes me think, going back to variable income, their glide paths say that they have lots of variable income and that they're going to invest at the beginning a lot, but they're not doing it. So my humble recommendation it would be that we should check a differentiation of the tracking error according to the different generations. Knowing that we went beyond that transition and there are already 5 years to adjust portfolios according to the glide paths and looking at what's going on there. As to nominal performance, we see some evidence that this performance has improved. Before the change, the performance was 4.5, 100%. Now it's 6%, 144 PB. It's circumstantial because we are in a interest rate period, very high interest rates, but at least is an indication that changing the model did not worsen the performance of the management. Now, if we look at the 12-month horizon, it's a very volatile period which could reflect poor performances if we measure them that way, and then a net performance indicator based on an average pension unit, a much softer indicator, much more stable in time, in which we see a differentiation between the youngest and the oldest workers, this covers until June 2022. I imagine the pressures to which the pressures over the regulator. It's not easy to digest. Promoters will not be able to sell it on the street because it doesn't move, it doesn't sell. And what if I had a spectacular year the year before, I want that be reflected in my sales force, and I understand that. But in terms of portfolio management, it doesn't really make sense. What we can see is that we are sending the wrong message to employees, to workers. In a 12-month yield, when things are going bad, with a pension unit performance, when we say we're doing spectacularly, but in terms of the pension is not doing very well, really. So once again, workers do not make the decisions using the right indicators, and they change from funds or the institutions inadequately. That's it. Thank you.
On target date funds. The good news is most of my slides have been taken, so I'll try to just focus on the stuff that is most relevant. What my team does is we oversee target date funds for BlackRock globally. The way I like to describe this is life cycle models instead of target date funds. We're represented in 10 different markets around the world. I oversee about $500 billion. And the reason why I make that point is that not every market wants target date funds, but most markets that we're in are looking for life cycle. Life cycle is a little bit different. A target date fund is a fund. The way we offer a lot of our life cycle, though, is we will break apart the target date fund and we will use different components within different markets. So what I was asked to focus on today was the US market. We could have done this in Mexico. We have assets in Mexico. We have assets in Taiwan, South Korea, Japan, United Kingdom. Mark made these points earlier, which I thought were very effective. I think everybody's made the points earlier. You can take more illiquid assets because that illiquidity premia is much higher the longer time period that I have. So time horizon is an important factor. The other one that's a very important factor is cash flows. So if I'm very young, I have a very long time horizon, and I'm going to be putting in lots of cash flows, that's a very different investment proposition to somebody that's 65 years old. They need cash coming out of the portfolio, and their longevity is going to be less than 20 years. So these differences change the way that we think about our portfolios, and that's why we have a very simple view on this one. We want to grow, maximize growth when young. We want to start protecting these assets, so reduce the variability as we get closer to retirement, and then in retirement it's about spending and the consistency of spending overall. This slide takes a little bit of time to go through. Bear with me just a second on this one. This is actually one of my favorite slides. And the reason why this is one of my favorite slides is this is the best description of a life cycle model that we've been able to come up with. I know it's not great, but it's as best as we can do. So what a life cycle model is doing is it's saying that the average person when they start working, we'll say in their early 20s, has a 100% unfunded liability 45 years in the future. That's called retirement. That's the objective of the life cycle model. It's not getting you to retirement. It's getting you to have consistent spending throughout your retirement. So these are not wealth maximizing products. Academically, we would call these consistent consumption products. Think of it as continual spending. So people in retirement want to spend the same amount in retirement that they do during their working years. So what this is looking at here, the green area is our objective. That's the liability. That's your retirement liability. That's the bucket that we have to fill up to get somebody consistent spending in retirement. That hump-shaped orange line is how the average person earns money over a lifetime. The average person outpaces inflation. This is in real terms. They outpace inflation during their early working years, 20s, 30s, into their 40s. They then lose to inflation thereafter. There's a whole lot of reasons why that happens. The black line is our objective, and the difference between the black line and the orange line is what we think the optimal savings rate should be. So when we think about our job at BlackRock, what we're trying to do is design an asset allocation, a glide path, that is going to maximize the amount of risk to minimize the amount that you need to save for retirement. Nobody says, I want to save more for retirement. I know that sounds weird, but nobody says, hey, you know what I really want to do is increase my savings rate this year. We feel like we have to do that. What people want to say is, I want to buy a car. I want to buy a new house. They want to consume. So what we're doing is we're balancing this long-term need with short-term behavioral decisions. So in this life cycle model, I'll just repeat where I started. What our objective is we have a 100% unfunded liability when you start working that is your retirement. And we have to fill up that green bucket to have you be able to spend consistently through retirement. So what has made these products so successful in the US? There's 4 reasons that we've come up with of what has made these very successful. And interestingly, the target date fund is really only one of them. So we spent a lot of time talking about the target date fund, but the target date fund is only a product. Target date funds in the US have been around since 1993. BlackRock was the originator of the target date funds. These funds had very little assets in them up until 2006. A couple people mentioned this. We had supportive legislation in 2006. The government came in and said, actually, these target date funds are a pretty good idea. And what we're going to do is we're going to give you guys some safe harbors to allow you to use target date funds. So it was called the Pension Protection Act of 2006. What this gave was companies were allowed to default individuals into target date funds. We also did this thing called auto-enrollment, auto-escalation. So what that means is when I started working, the company automatically put me in the fund. They put me in at 3%. And then every year that I'm working, they would increase that savings rate by 1 or 2 percentage points. So what that did is it took a lot of the behavioral guesswork out of this. So having a supportive regulatory framework was exceptionally important to us. What then happened was the market duked it out. So our cost structure was much more expensive in the early 2000s, where now you can buy a target date fund for single-digit basis points. My team just launched a series of target date fund ETFs in the US market. I think the average fee on those is 9 basis points. I'll come to the outcome versus alternatives, and then the behavioral framing. A few people have touched on this. There's great work by Richard Thaler. He won a Nobel Prize, I think it was 2014. It might have been a little bit later than that. And he talked about the nudges. How do we nudge people into doing the right thing? Mark talked about a lot of the naming convention of the non-target date funds in the NEST plan. Those are nudges. You're nudging people to make the right decision or to avoid the wrong decision. These are the 4 reasons why target date funds have been so popular in the US. The asset growth, what we're seeing right now, there's about $3.5 trillion with a T, $3.5 trillion in assets in target date funds. They make up about 1/3 of all retirement assets. That number just continues to grow. They continue to grow not because just simple popularity, they grow because they're highly effective. I mentioned earlier, costs have come way down. Here are the costs of where we've come from. These costs only go back to 2018. When we started our target date fund was in, the target date index fund was in early 2000s. The fees on that were about 30 basis points. Right now we're selling our target date fund for about 5 basis points. So fees continue to go down as assets go up. And you can see in the passive funds, which is where most of the assets are going, that's on the far right, the minimum fee for the retail market, that's not even the institutional, for the retail market is 8 basis points. But importantly, what we've seen is target date funds do better than alternatives. What this is looking at is LifePath, the product that I oversee, and what's missing on here is the yellow is a 60-40 portfolio, so a traditional balanced fund. So what we were unseating within 401k portfolios or 401ks in the US, pensions in the US, were 60-40 portfolios. And what you see is that the target date funds outpace the 60-40 portfolios, the traditional balanced funds. Importantly, that's because we're taking more risk for young investors. There's really not much science other than equity markets have gone up. Target date funds take more equity risk for longer, therefore you're seeing better outcomes. The other point is you're seeing better returns in the near dated vintages as well because they take less risk, so more certainty near retirement. This is an older study, but it's one of my favorite studies. Morningstar does this. What this is called is the investor return. What the investor return looks at is the actual return that an investor earns, not the return that you're seeing on the fact sheet. So for example, we see this regularly. Let's just pick one here. Take US diversified funds. These are like large cap funds. People buy a lot more large cap US growth funds these days because large cap growth funds are going up. They're buying the trailing performance. But what you see consistently is that negative 0.74% is they're actually buying it at the wrong time. They're buying high and selling low. You see this consistently across all different portfolios except one, which is the target date fund. And why is that? Because we've taken a lot of those decisions away from the individual. We default you into the product. We automatically rebalance the product for you. We automatically increase the amount of savings rate. The corporates do that. We automatically increase the savings rate every year. So what you actually see is the individual has better returns than the target date fund does on the fact sheet because you're buying systematically. It's all those things we learn in finance. That's what we're doing within the US market, and that's what continues to drive better performance. This is a great study. What this looked at are what are called guided solutions. Just think of that for simplicity as target date funds in the US versus individuals picking their own funds on the menu. Clearly what you see here across all age cohorts, the guided solution, with one exception, is outperforming the non-guided solutions, significantly outperforming the non-guided solutions. So saying this differently, target date funds outperform the individual investor. Kind of an interesting story. The biggest holding of individual investors in US pension plans, people that want to do it themselves, is cash. What happens usually is people go out and they think they can pick stocks, they think they can pick, buying gold versus something else, they get it wrong, and then they leave the money in cash and just forget about it. Target date funds avoid that because we continually recycle those assets. So hopefully this provided some good insight into why target date funds have been successful in the US. I'll talk about the future here, but I wanted to just end on this slide. These are the nudges. If you're looking for something to read, if you like reading finance books, there's a book called Nudge by Richard Thaler. I'd highly encourage you to read it. What it really talks about is how we can do things for individuals to nudge them to make the right decision, but not force them into making the right decision. So where I started this presentation, at least what made target date funds successful, it's not just the target date funds successful, it's we've created the right environment for target date funds to be successful. And that's because of things like the nudges. We've reduced the cost. We've beaten the alternative products. So it's not just the target date funds, it's everything else we've used with the target date funds. So what I want to do now is spend just a couple more minutes on the future, and then hopefully I'll get us mostly back on time and we can open it up to questions. So the future within the US is very interesting. What we're seeing is the same thing we're seeing everywhere in the world, is the demographic problems. There's three broad trends that we're seeing in the US. We've talked about alternatives quite a bit here already, so I won't touch on the alternatives. Alternatives are very tricky in the US because we have to provide daily liquidity, which is a weird quirk of the US system. We don't have to do that in Australia. The UK is different as well. The first two I'll touch on here for just a second. As we move closer to retirement, there's two trends that are growing. The first one is what's called personalization. In the US, we have the technical capability of breaking apart the target date fund and then providing individualized target date funds. So instead of owning, call it 10 different underlying index funds in a target date fund in a single wrapper, we can break those 10 indexes up and give you your own customized glide path and customized asset allocation. This has been a big trend. One of the problems we've seen it's very expensive to do this. So I talked about fees earlier, and this is why this hasn't really picked up very much yet. Fees earlier on a target date fund are 8 or 10 basis points. If you want to do personalization, it's going to be 50 basis points on top of that. So you're looking at about a 60 basis point total fee on the lower end. And what we haven't seen is the benefits outweigh the costs of that. So we've seen lots of companies like to talk about these. We haven't seen very big benefits. One of the positives is we do see better engagement with the personalized portfolios, which is good. The second one is retirement income. So in the UK, which we're doing a lot of work right now in the UK on this, the UK moved away from annuities in 2015, 2016. What we're now seeing is the creation of these institutional annuities. BlackRock's in the market right now. We launched the product in the US in about 2 weeks. Institutional annuities. These are not the retail annuities that many of us know and remember, but we're beginning to embed those into target date funds. So think of this as another asset class. You have stocks, you have bonds. Now we're going to have insurance products embedded into target date funds with an option of creating lifetime income. So it's this hybrid structure between a defined benefit plan and a defined contribution plan. Not all of the assets will be annuitized. Somewhere in the area of about 30% are annuitized. Just very briefly on this is a study. You don't have to read this. We'll send the slides around. The punchline is 30% allocated to insurance, institutional insurance here, this isn't retail, institutional insurance for a retired investor will reduce the overall portfolio volatility by 30% because these are illiquid products, but will also increase the spending of that individual by about 25 to 30% depending on where you are in the income threshold. So this is a very big change. Behaviorally though, there's some big problems we have to do to overcome this. So I'll close on this slide. There's a trend that we often hear about, which is this DB to DC, and the Chilean market's very interesting because it's the roots of the structure are more of a defined contribution market, and I think that's the wrong way to look at it. It's not DB to DC, it's this rise of professionalization. And my point in that is if I think about what target date funds have done very well is they stepped in where defined benefit plans in the US did not do very well. So we professionalized asset allocation, we professionalized rebalancing, we professionalized manager selection. We professionalized cost negotiation. Now what we're doing is we're professionalizing decumulation and insurance. So what you're seeing is this move towards not from a DB to a DC, you're seeing this move towards overall professionalization. Thank you.